Welcome back to the Gold Standard. I'm here with Sasha Reyes, and this week the market's handed us a lot to work through.
Marcus, that's an understatement. Gold fell hard toward $4,500. Silver crashed over 13% in a single session. And India just rewrote its import rules overnight. 3 distinct forces. 1 week. Let's break it down.
Here's why this matters. The inflation data that hit this week wasn't just a number. According to Bloomberg, it's actively lowering the odds the Fed cuts rates this year. Gold felt that, so did yields, the dollar, and precious metals broadly.
And silver felt it harder. USA Today reported silver sitting at $76.15 on Friday, down from near $90 just days earlier. That's a 13% single-session drop. Does that make sense why we're paying close attention?
To put this in perspective, that's not just macro pressure. We'll walk through the gold-silver ratio and what analysts are watching to figure out if this is a shakeout or something deeper.
Then there's India. Reuters confirmed the government raised gold and silver import duties to 15%, one of the steepest hikes in years. Silver also faces direct import restrictions on top of that. That's a demand shock hitting at exactly the wrong time.
A demand-side headwind hitting at exactly the wrong time for silver.
And on the mining side, Reuters reported Equinox Gold is acquiring Orla Mining in a deal that creates an $18.5 billion North American gold producer, backed by Pierre Lassonde. That signal matters a lot.
Record Q1 earnings, accelerating consolidation. The important thing to understand is that even while prices pull back short-term, the big players are still betting long.
All of that converges in this week's conversation, right after this.
Gold just got hit hard. We're talking a fall from recent highs all the way toward $4,500 an ounce, and the culprit is something this market has been dreading for months.
Hot inflation, again. And when it lands like this, when the repricing is this fast, you know the market had been pricing something different.
Exactly. May 2026 CPI data came in hotter than expected, and the market repriced fast. According to Bloomberg's coverage by Yiwei Ye, gold held a decline after the U.S. inflation acceleration lowered Fed rate cut odds significantly.
And when rate cut odds fall, yields climb, the dollar climbs with them. Gold gets squeezed from both sides simultaneously. That's the mechanical pressure.
Here's why this matters. Gold doesn't pay interest, so when real yields rise, the opportunity cost of holding bullion goes up. Every basis point higher in yields is a headwind.
And at these price levels, that headwind is stronger than ever. Kitco reported gold slipping for a second session straight as hot inflation data killed rate cut hopes. That's not one day of noise. That's a structural shift.
2 sessions of selling in a row. The direction is clear.
So where do the numbers land? Jackson Chen's piece on mining.com put gold falling back toward $4,500, and Kalshi's market pricing showed over a 50% chance of a rate hike as far out as next January. And that second number, that changes the entire conversation.
A rate hike, not just no cut, an actual hike.
Right. And that's the scenario the gold market is trying to price in now. Here's why this matters. If the Fed is tightening rather than easing, the calculus on holding a non-yielding asset changes completely.
To put this in perspective, gold had been building towards a strong position coming into May. The setup looked constructive. Then the inflation print landed and the repricing was sharp.
Kitco's report Friday noted gold dropped 2%, and yes, that's significant, as rising yields and a stronger dollar sapped its appeal. Inflation woes lingering, that's how they framed it. 2% in a session matters.
And yields and dollar moving together is the worst combination for gold. You're not getting a safe haven offset. Both macro levers are pointing the same direction.
Yahoo Finance tracked gold falling toward $45.50 that same session, framing it directly as Fed cut hopes fading. So multiple outlets telling the same story from different angles. When consensus is that tight, listen closely.
Which tells you this isn't interpretation. The market read is consistent.
Now here's where it gets really instructive. Gold dropped roughly 2%. Painful, yes. But silver told a completely different story.
Silver got hit much harder.
USA Today reported silver falling 13.12% on May 15th alone. Let that number land, 13% in a single session.
Wow.
The price landed at $76.15 per ounce.
And Forbes had the detail on that move. Connor Murray's piece noted silver tumbled to $76 on Friday, just days before approaching a 2-month high near $90.
$90 to $76 in days. That's not gradual, that's a repricing.
That's the dual nature of silver working against it. It trades like a monetary metal when sentiment is positive, but the industrial component amplifies the downside when macro fear takes over.
The important thing to understand is that silver's industrial demand story, solar panels, electronics, EV components, that doesn't disappear overnight. But in a risk-off session driven by rate fears, that industrial angle becomes a liability instead of an asset.
Because if higher rates slow growth, industrial demand softens, so you lose on both the monetary and the industrial side at the same time.
James Hierchik at FX Empire framed it well. Silver's outlook now hinges on 3 things: inflation, yields, and Fed signals. The same 3 forces hitting gold, but with a much bigger multiplier on the downside for silver.
Silver led the weakness, then gold followed. The sequence tells you something.
The sequence matters. It tells you the market wasn't just reacting to one data point. Pressure was building across the week.
And now the real question is whether this is a flush and reset or the beginning of a longer adjustment period as the Fed holds or potentially tightens. That's where the debate sits this week. Here's the thing. The macro headwind from inflation and yields is one layer of pressure on gold. But this week also brought news from one of the world's largest gold-consuming nations. News that adds a demand-side dimension to a story that's been mostly about rates. Does that demand picture change how we read the sell-off?
That's exactly the question, and the answer coming out of India this week is significant. It could fundamentally reshape how we read this entire sell-off.
On top of that inflation shock, there's a demand-side story that's just as significant, maybe more so. India just raised import duties on gold and silver to 15%. Reuters confirmed this week, one of the steepest levels in years. And the timing couldn't be more pointed. You've got price pressure from yields and the dollar, and now the world's second-largest gold consumer is actively discouraging imports.
Right. To put this in perspective, India typically consumes somewhere in the range of 700 to 800 tons of gold annually. That's a massive slice of global physical demand. Any meaningful reduction in Indian buying shows up in the global price.
So walk me through the mechanics here. Why is India doing this?
2 reasons, really. Hindustan Times reported the government is trying to narrow the trade deficit and defend the rupee. Gold imports are a significant drag on the current account. Here's the policy mechanic. You raise the cost of buying imported gold, you reduce the volume.
Makes sense from a policy standpoint, but for markets the question is how much demand actually gets suppressed.
Kitco had expert commentary on this, noting the tariff hike from 6% to 15%. That's a near threepling of the duty rate. At current gold prices, that's a meaningful premium that price-sensitive buyers, especially in the jewelry segment, simply can't absorb. Does that make sense?
And Indian jewelry demand is exactly the segment most elastic to price. These aren't institutional buyers with a mandate. These are households and retailers responding to affordability.
Exactly. And there's another layer here. This is important. Kitco also flagged the risk of gray market inflows picking up as official channel costs rise, which is ironic because that would actually undermine the rupee defense goal entirely.
So the policy might create the very problem it's trying to solve.
That's the tension experts are pointing to, yes.
Now, silver gets its own treatment here, which is worth separating out.
Nodding. Reuters reported yesterday that India has moved to restrict most silver imports under a separate set of controls. This isn't just the tariff hike, it's a direct import restriction layer layered on top of it.
So silver is getting squeezed from 2 sides simultaneously. You've got the global macro sell-off we covered earlier,
Right.
and now a structural demand shock from one of the key import markets.
And the Hindustan Times piece confirmed platinum got hit too, with its duty going from 6.4% to 15.4%. So here's what's happening. This is broad-based, a coordinated policy move across the entire precious metals complex.
Here's why this matters beyond the immediate week. India's policy shifts on gold have historically had a lag effect. Demand doesn't evaporate overnight. Buying shifts to the gray market, gets deferred or substituted, but the pressure accumulates.
The MSN report on Q1 miners touched on this directly, noting India's duty hike could reshape jewelry demand going forward. That's a medium-term headwind sitting directly on top of the near-term rate fear sell-off. Two distinct pressures.
Two distinct forces pointing in the same direction. That's a meaningful confluence.
And for silver specifically, the timing is brutal. The metal was already down hard this week before you even factor in the import restriction news. That's the convergence, dual pressure hitting simultaneously.
Which brings us to silver's own story, because the percentage moves we've seen this week aren't just spillover from gold. Silver has its own volatility signature, and understanding that matters if you're trying to read where it goes from here.
Curiously, the gold-to-silver ratio right now tells a specific story about relative positioning. And here's what matters. Analysts are watching three variables very closely to figure out if this is a shakeout or something structurally deeper.
We'll break that down right after this. Right. And here's why that matters for anyone trying to read this. Silver doesn't just track gold, it amplifies it. When gold sells off because of macro pressure, silver sells off harder. When gold rallies, silver tends to overshoot on the upside too. The ratio is a useful barometer for where sentiment sits between the two metals.
So, the current blowout in the ratio, what does that historically signal?
It signals crowded fear. When silver gets hit this hard relative to gold, it usually means the industrial demand fears are doing extra work on top of the monetary sell-off. You're pricing in slower growth, stickier inflation, and rate pressure all at once.
FX Empire's James Hierchek framed the outlook around three variables this week: inflation trajectory, how long yields stay elevated, and whether the Fed signals anything at its next meeting. Those three things pretty much determine whether this is a shakeout or a longer structural correction.
Walk us through those scenarios.
Okay, let's think about this. If the next inflation print cools, you could see rate cut hopes creep back in. Yields pull back, dollar softens, and silver gets a bid. That's the recovery scenario. But if inflation stays hot, yields hold where they are, and the Fed stays quiet, silver has no catalyst. That's when a technical breakdown can feed on itself.
And the third scenario?
Fed signals something hawkish. That's the worst case for silver right now. The market's already nervous about a January rate hike per Kalshi's pricing. Any confirmation of that tightening bias, and the entire macro headwind intensifies.
Now, for investors already holding silver, the harder question is whether this sell-off fits any historical pattern, and it does. Look at inflation-driven sell-offs in cycles where rate hike expectations repriced sharply. Silver took heavy damage in the near term, but recovered when the macro picture clarified. The issue is timing the clarification.
So this isn't a call to panic, but it's also not a call to aggressively buy the dip without thinking through the thesis first.
Exactly. Mohammed Umair over at FX Empire noted the long-term bullish structure in silver stays intact if price holds above the key breakout zone. The short-term pressure is real. The longer-term demand case from industrial use hasn't gone away. Those two things can both be true simultaneously.
Right, which is why silver deserves a separate analytical framework from gold. Same macro inputs, very different demand drivers.
Now flip that on its head. While spot prices are getting hammered and investors are reassessing short-term exposure, the biggest players in mining are writing nine-figure checks. Equinox Gold just made a move that signals something very different about where conviction actually sits long-term.
A $5 billion acquisition tends to make that case pretty clearly.
Shifting gears to the deal that cut through all this week's noise, Equinox Gold is acquiring Orla Mining in a $5.1 billion deal, and Reuters confirmed it creates an $18.5 billion North American gold producer.
And this wasn't just any handshake deal. Kitco reported it has the backing of Pierre Lassonde, which is about as clear a signal of conviction as you get in this industry. That's not speculation. That's institutional confidence.
Here's why the scale argument matters right now. When gold prices are elevated, bigger producers have lower all-in sustaining costs spread across more ounces. The margin leverage is real.
And the timing connects directly to what Van Ack flagged on Seeking Alpha this week. Top miners posted record Q1 2026 earnings. Here's the mechanic. High gold prices flow straight to the bottom line when your cost base is fixed.
MSN had a good piece on this too. Discovery Silver, I-80 Gold, Wesdome, all advancing major projects, maintaining guidance. The earnings picture explains why miners are outperforming bullion itself on a percentage basis this year.
Right, and that outperformance is exactly why deals like Equinox Orla happen. You have strong equity currencies, motivated boards, shareholders hungry for growth, not just exposure. That's when the big moves are written.
So what's the signal here for investors watching the sector?
Toughtly, consolidation at this pace has historically shown up late in a bull cycle. Not a warning sign, necessarily, but a marker worth watching. Here's what it signals. When the big players rush to lock in assets, they're signaling prices stay elevated long enough to justify the premium.
The important thing to understand is that Equinox isn't buying Orla because gold at these levels is a sure thing. They're buying because they want to be positioned if it is. That's a different kind of bet.
Exactly. And for investors, the takeaway is pretty direct. Senior producers with scale and low costs are where the earnings leverage concentrates. That's the part of the market that benefits most when prices hold.
The week handed us a rate hike scare, an India tariff shock, silver down hard, and right through it all, a $5 billion acquisition closed. That's the clearest read on where long-term conviction sits.
Smart money is still making the long bet on gold. The short-term noise, the rate fears, the tariffs, the silver sell-off, none of it changes that calculus.
So, that's the episode. Two big forces colliding this week. Inflation coming in hotter than expected, and India drawing a harder line on imports, both hitting gold and silver from different angles.
And the silver discussion really landed for me. That single session move was dramatic. Here's what stood out. That three-variable framework. That's exactly how you read whether this is a shakeout or something structural underneath.
Right. And the Equinox Orla deal underneath it all showing that long-term conviction in gold hasn't gone anywhere despite the short-term noise.
That's the through line. Macro pressure pushing down, consolidation building below. The divergence is what tells the story.
If this episode gave you something useful, subscribe wherever you listen and drop us a review. It genuinely helps.
Questions or thoughts? Reach us at goldstandard@heymato.com. We read every single one.
Thanks for being here. I'm Marcus Blackwell.
And I'm Sasha Reyes. Thanks for the time. See you next time on The Gold Standard.